All right, welcome back. JPMorgan and Chase, they topped their estimates here today. They reported, those banks let us know how they were doing, right? And they had better than expected results. We'll start with revenue. They beat on top and bottom line. For fixed income trading and investment banking was good too. The U.S. economy remains resilient in this quarter, said Jamie Dimon, the head honcho over at JPMorgan. JPMorgan's trading operations were able to benefit from turbulent conditions in the quarter as President Donald Trump roiled the markets with his push to overhaul global trade agreements. Remember? Citigroup reported second quarter results on Tuesday that topped analyst expectations after a 3-month period that saw the bank's stock dramatically outperform the market. Citigroup reported total markets revenue that was higher by 16% versus the same period a year ago, and equity revenue alone rose 6% year over year, and it was up 7% from the first quarter. So all good, right? Banking was another bright spot with revenue up 18% at Citibank over the second quarter of 2024, even with losses on loan hedges. All three companies reported better than expected second quarter earnings, but mixed results on net interest income. That might be weighing a little bit on some of these financial stock prices. My next guest watches all these banks. Please welcome to the show, Mr. Luke Lloyd. Luke, thanks for being on, brother.
Absolutely. Thanks for having me.
I know a lot of folks, we've been talking about it for a week here at least. We're looking, gearing up to see what these banks would report. And one of the things we were going to be looking at was loan loss reserves. And the only one I really got to take a peek at before we came on air was JPMorgan. And they didn't put as much aside for bad loans. And I guess that's a positive. And then you take that into consideration what Jamie Dimon said. Looks like things are okay. What do you say?
Yeah, I mean, Jamie Dimon's actually usually very bearish in many ways, and he kind of toned it down, it seemed like, on this earnings report, which is kind of unlike him, which, I mean, I guess he's been bearish for so long, and the markets have ripped higher. Maybe him not being so bearish, maybe that's a sign we should get bearish, right? But at the end of the day, I think the loan loss reserves, tell you something. Also, we did see a small uptick in credit delinquencies. They did talk about that briefly. But the biggest thing I think across the board you have to pay attention to is that investment banking arm, because, again, there's no such thing as a win-win situation when it comes to investing or the markets, but I kind of like the investment banking realm, whether interest rates go up or whether they go down. So it's kind of like a call option on either way, because if interest rates go up, that actually makes it harder for the smaller cap companies to survive. So they're going to look for an out. They're going to look for somebody else to come buy them out. So that helps investment banking. Then on the other side, if interest rates go lower, it allows people to borrow more money cheaply to acquire other firms. So I think the investment banking arm is actually going to continue to remain strong, whether the economy even deteriorates a little bit, whether interest rates go down or up. I think that's going to remain strong. So look at those investment banks specifically, and you can even go smaller down the cap spectrum, like something like Lazard, LAZ. That's another investment bank that's rocked pretty high since April as well. So I would take a specific look in that sector.
And maybe you disagree with me, or maybe not, I don't know. But I mean, I think that generally speaking, I'd say the economy is doing okay, but there still are some parts of it that are still smarting. And I think that that's what you get with an economy that you're trying to make better, because we had some real bad parts of it over the last 4 years. So I look at it like an aircraft carrier that we're trying to turn around, and it just takes time. It's not a PT-109 boat that you can turn on a dime. And it's going to be something that we're going to have to watch over the next few months or maybe a year, because there's just so much to it, and the economy is so big. You hear people say it's up to, say, $30 trillion. A $30 trillion economy, if you're going to try to turn around, that's going to be a pretty big ask and a big tug. So are you seeing a 40,000-foot overall good economy? Where do you stand when it comes to that macro kind of deal?
It's such a tough question, Scott, and I think me and you think very similarly around this. We think very alike in regards to the economy can be good at the surface level, but behind the scenes it can be really bad, but the debt Ponzi scheme keeps it going like we always talk about. But I think generally speaking, the economy's in a good point for a couple different reasons. Number one being that it kind of feels like the market specifically, at least, and this also goes along with the economy, the other countries around the world are playing nice with these tariffs. I think the big sell-off we saw in March and April was suggesting that other countries weren't going to play nice. So I'm not in the camp, again, that tariffs are going to be this everlasting thing. I think by the end of this year, we get some stuff figured out. That could help stimulate the economy. Then you combine that with the fact that we do have the big, beautiful bill, which prints money and stimulates the economy in that aspect. Yeah, in the short term, I think economically we're looking pretty good. The only caveat to this all is, I think, to the lateness to the game that the Federal Reserve is to keep the debt Ponzi scheme going at these higher interest rates. I think a lot of people are going to be feeling the pain pain. Companies, governments are feeling the pain with higher interest rates. So if we get lower interest rates, it's almost like this triple stimulus between maybe better trade negotiations, freer trade around the world. You have the big, beautiful bill with stimulus. Then you have combined that with also lower rates down the road. That's almost a triple stimulus hitting the markets and the economy. So as long as that employment market remains strong, people will continue to spend money. They'll continue to borrow money. Credit will be available. Banks will lend money, and the whole debt punch scheme gets bigger. So yeah, the economy is good until it's not, maybe 4, 5, 6 years down the road.
Yeah, I mean, you're right. And we had some decent news. I mean, we've got wages growing around 4%. You look at our inflation's at 2.5%, 2.75%. So that's not a big enough gap to make up for a lot of the ills that are out there, but it is better than it has been. So that's better to see everybody making more money than they're losing on inflation. But then let's get to the million-dollar question. Do you think the Fed should cut rates?
Yes, I think they should have cut rates a couple months ago. I mean, I think they're late to the game, but it's not what I think. It's not what I say. What I want to happen has no meaning, because what I have to do for my clients is position around what actually I think is going to happen. So again, when it comes to the Fed, I think they're stubborn. They're a little bit arrogant. I think they've been right in some ways, but in many, many ways, I think this tariff inflation is not going to happen, frankly. I think actually tariffs are more disinflationary if they do exist, and they do get put on August 1st. I think that Jerome Powell's scared to pivot because they were so wrong the first time around. So yeah, I think they're late to the game, but it's very interesting the market today. For example, you mentioned NVIDIA. The NASDAQ's up. Equal weight S&P's down like 1%. Small caps are down over 1%. The S&P itself is down like 0.2%. So you have the NVIDIAs, these 7 or 8% weightings in these, the market, indices that are carrying this entire market. And frankly, I don't think that the investors have gotten the idea that when rate cuts happen, it's going to benefit essentially every single stock outside of the big tech names and top 7 stocks. So at some point, whether it's small caps or the underlying 493 or the equal weight S&P, I think you're going to see a very, very strong rally sometime this year when actually investors start realizing we are going to get rate cuts.
Yeah, I got made fun of this morning. I said on another network, I'm trying to find some bad news here about what the market's going to, going forward, because everything I look at tells me that I want to be fully invested, right? And I think that I'm smelling the same thing coming from you. And then you add into the fact that there's $7 trillion of pro money on the sidelines that got out in April that needs to come back in. That could also light another fire. So I appreciate you coming on.
If you didn't own NVIDIA,
go ahead.
Yeah, if you didn't own NVIDIA, you're missing out. So you need to kind of buy the other stuff to catch up, right? I think that's what a lot of fund managers are doing right now.
You're right. All right, great stuff as usual. Mr. Luke Lloyd coming to us from Covington, Kentucky with